Okay, good morning, class. Now, you're welcome to week 4. Week 4. We are going to week 17. That means we are going to week 17. That means after today, we have how many weeks left? 13 weeks, Abi? So it's not so long ago. It's not so long again, but we have a long journey, a lot of things to learn. Okay, so I can see some new faces. There are a few of you that are just coming for the first time, but most of you have been in this class. So far, what we have done around approximately 12 or 13% of the syllabus. Luckily enough, there are the backgrounds that are theoretical that you can easily still read up. And luckily enough for you, you can always still watch these videos if you choose to. If you don't want to, you can read the handout. Very explanatory, right? So in week 1, what we're able to achieve in week 1, we're able to set up the foundation for this class. We established the syllabus and how we want to cover it, which I've shared on the group. I will share it again. Also in week 1, we started the regulatory framework. So in week 1, we were able to understand the regulations that governs reporting by looking at those regulations as well as the regulatory bodies that develops those regulations. You see, we're able to learn that in Nigeria, our regulatory framework is IFRS. Not only IFRS, because there are 3 of them. There are 3 gaps: accounting standard, company law, local stock exchange listing requirement. So we agreed that our regulatory framework in Nigeria is a mix of principle-based framework and rule-based framework. For the principle-based framework, we said that one is IFRS. It's because we are using IFRS. That's principle-based. For the rule-based, it's because of company law and the local stock exchange listing requirements. So it's a mix. We use a mix of principle and rule-based. In week 2, we move to conceptual framework. And because IFRS is principle-based, then it means that that IFRS must have been developed using some set of principles. You see, those set of principles is the conceptual framework. So what we looked at in the conceptual framework was to learn those set of principles, which we categorize into 8 chapters. There are 8 chapters of them. And the most interesting one for me, I don't know for you, the most interesting principle for me is that principle of faithful representation. It's pregnant. Faithful representation. You see, is most of these standards, most of them you will find out that they uphold faithful representation to a large extent. In fact, to a full extent. Because faithful representation is saying that present your underlying economic activities the way they are. Present it faithfully. Then he was talking about that, okay, your report should be complete, your report should be neutral, and your report should be free from errors. It's deep. And he went on further to talk about prudence. That prudence is supported by, or is supporting neutrality. Saying that you have to be careful. You have to exercise care when you are making judgments under condition of uncertainty. In almost most of the valuations or measurement that we do in reporting, prudence is part of it. Allowance for receivables, impairment, inventory obsolescence, all of these things include prudence. Prudence is very powerful. Not only that, inside faithful representation, there is now substance over form. Inside faithful representation, economic substance over legal form, saying that in reporting, All transactions are recognized and measured in accordance with their substance, in accordance with their economic substance, not their legal form, which is true. All transactions recognized based on their substance, based on their financial and economic reality. And that's the most interesting one for me, faithful representation. So you need to go through all of these principles from chapter 1 through to chapter 8. Okay? If you don't have the recording, I'll share it with you so you can watch it. If you don't want to watch it, read the video, read the notes, very explanatory. Now, week 3, which is last week, we looked at IAS 1 last week. And IAS 1 is presentation of financial statements. And I told you that for IAS 1, it's going to be replaced with IFRS 18. And that's going to happen in 2027. I told you early adopters can do that. From next year, they can start adopting early if they want to. But for now, based on your syllabus, we have IAS 1. So I can't start teaching you IFRS 18. But the difference are not much. It's just that template that actually changed a bit. It changed a bit. So the focus of last week was that I gave you the structure and the content of a financial statement. And there are 6 content of that financial statement, from the statement of financial position to the statement of profit or loss, to the statement of changes in equity, to the statement of cash flows, to the notes comprising significant accounting policies, and also to the statement of financial position at the beginning of the earliest comparative period, where there is retrospective application of a change in accounting policy or correction of a prior period errors. You see that note 6 or that final statement, you might not understand that now. When I teach you IAS 8, you understand that better. So we then went ahead to give you all the templates. We wrote everything in the board, which you took into your notes. Now, the most exciting one for me, out of all those statements, is the fact that there are certain things you need to put in each statement before you start preparing your account. Those 5 items that you use to identify financial statements: the name of the entity, the title of the entity, the reporting date, the reporting currency, and the level of rounding off. Those 5 things must be on every statement that you prepare at every point in time, whether in practice or in the exam. Okay? And another very interesting one for me was the statement of financial position. The fact that the statement of financial position is classified for assets and liabilities into current and non-current. And IAS gave us definition for current. We now say that any other asset or liabilities that does not meet those definitions becomes non-current. I love that in the sense that it opens up judgment. It's not saying that this has to be current, this has to be non-current. It leaves your judgment to decide which is current and which is non-current. And I also made a point in that statement of financial position that when you're arranging it, it must start with PPE for your non-current asset. Then the others can come anyhow. For current assets, it must start with inventory and must end with cash and cash equivalent. That is particularly important to arrange it in that manner. I also said that this classification into current and non-current is assuming that the entity has a clearly defined operating cycle. It has a what? Clearly defined operating cycle. If an entity does not have a clearly defined operating cycle, it's not possible for it to classify its assets and liabilities into current, non-current. And I told you that examples of companies that cannot do that are entities in financial industry, financial services, majorly, like banks and non-financial institutions, all of those entities. You will see them arranging their assets and liabilities in order of liquidity, where it will start with cash and cash equivalent, and they will separate it into current and non-current, right? And I said some other things too. Okay, so that was the major highlight for last week. Now, week 4. Today, I'll be moving to IAS 16, property, plant, and equipment. IAS 16, property, plant, and property, plant, and equipment. Okay, so this will take me 3 classes because I want to solve a lot of questions. So today, we won't really be solving so much questions. I will just explain the principles which you are supposed to revise and get ready against next week, where we'll start solving a lot of questions. Now, PP, what I'll be teaching you under PP are these. Number 1, I will immediately explain the definition. Then, I will go to recognition. Then, I will go to measurements. Then, I will go to presentation and what? And I can tell you for free, this is what I'll be teaching you in all the standards I'll teach you. All standards have this structure. And why? Because they are all developed from the same set of principles. You will see the conceptual framework. This is how the conceptual framework was aligned. This is chapter 4. This is chapter 5 of the conceptual framework. This is chapter 6 of the conceptual framework. This is chapter 7 of the conceptual framework. All standards are structured like that. And that was one of the advantages of the conceptual framework. Okay, now, let me start with the definition of property, plant, and equipment. So, to define it, let's go to IAS 16 and see how we define PPE. IAS 16 said that I'll be shortening this to PPE going forward. He said PPE is any tangible item that is held for use in the production that is held for use in the production or supply of goods or services rentals to others and for administrative purposes, and it is held for use for more than one accounting period. Okay, PP for more than one accounting period. The same way you must know all those definition of asset and all of that. This definition of PPE, there are key elements that must be there. However you arrange it, we are less concerned. There are things we are looking for. And if you look at this definition I have on the board, the first thing I have here is that PPE is any tangible item. Tangible means that it must have physical substance. It must be something we can see or touch. Any item that is tangible. That is one. If it is not tangible, it can never be PPE. The second thing is that PPE must be held for what? Meaning that it must not be held for sale or for whatever reason. It must be held for use. You must be using it as an entity. Now, using it for what? Then they now broke it down that you are using it either for production or supply or rentals or administrative purposes. That's around 4 uses, abi, as listed in the standard. And of course, from experience, those developing this standard, they said, okay, those are all the uses. It cannot be more than that, right? So if there are anyone further, maybe they would adjust this definition. But for now, that's all the uses. So number one is production. Any item, tangible item that you use to produce is PPE. It doesn't have to be something very big. Even if you are a cobbler and you have your small machinery that you use in making your palm sandals, it's PPE. If you are a content creator and you are using your phone to create your content, that's your PPE. If you want to prepare your account for the year, all your tripod, your everything is your PPE because you are using it to produce your goods and services. So you need to understand the idea of production. Whatever it is that you are producing, whatever it is that you are selling, that item that you are using to do it is likely going to be what? PPE. So there are a series of examples. But the popular one that people will think is plant and machinery and all of this. No, it's beyond that. Okay? It doesn't have to be so big, right? Even though materiality in terms of amount is important when we want to capitalize an item. I will get there, right? But production. Second is supply. Delivery van, motor vehicle that you use to supply your goods to your customers, right? These telecom companies, what do they use to supply their goods to their customers? Most of them have these fiber optic cables, right? That would be PPE to them because they use it to supply. And maybe a company that is selling gas to gas station and it has an underlying pipe. Those pipes are used to supply. I mean, whatever it is you're selling, and you have an item that you use to supply, that item is PPE because you are using it to do what? Supply. Then, rentals to others. If you have an item that you rent out to others, and you know what renting to others means, it means they will return it. Abi? It's PPE. So if you have an item that you rent to others, it's PPE. Whatever the item is, whatever it is, it's PPE. And finally, for what? Administrative purposes. Administrative purposes like your furniture and fittings, right? Your air conditioner, your computer equipment, your servers. Server is not a physical item. So your elevator, Abi, all of these are administrative purposes. You see, that administrative purposes is saying that without these other items, you cannot even function as an entity. If you have staff and they don't have where to sit down, they can't function. So it's for admin or air conditioner, everywhere is heated up. or no fans, no equipment, no fittings and all of that. So those are for administrative what? Purposes. All those items will qualify as PPE. And more importantly, if you have any of these items that you are using for production or supply, rentals to others, and for administrative purposes, for it to PPE, for it to be PPE, it must be held for use for more than what? One accounting period. If you are holding it for use within 1 year, it can never be PPE. It cannot. It must be held for use for more than one accounting period. Okay. So that's the definition of PPE. So from this definition, do you think PPE should be classified as a current asset or a non-current asset? Why non-current assets? Thank you very much. Because it is held for more than 1 year. Current assets, it must be held, it must be realized within 1 year. Okay, so that's the definition of PP. Any questions here? Now, let's go to the next one. Recognition. I'm sure you remember chapter 5 of the conceptual framework that talks about recognition and derecognition. So recognition is the process of including an item in the financial statements. And I told you that day that before you can recognize an item in the financial statement, it must meet some recognition criteria. So the key thing here is this. Before you can recognize an item of PPE in the account, what are the criteria it must meet? That's what we want to look at here. Recognition criteria for PPE. There are two of them. Number one, it is probable that future economic benefit associated with the item will flow to the entity. It's probable that future economic benefits associated with the item will flow to the entity. Number two, it must have a cost that can be measured. It must have a cost that can be measured reliably. These are the two recognition criteria for PPE. That even if you meet the definition of PPE, that you are from the definition known that this item is PPE, before you can record it in your books, it's not just about being used for production. It must be probable that future economic benefits associated with the item will flow to you. This is about control. That the economic benefit that you would get from the item, is it associated to you? That means you have control. You must have control of that item. That's one. Number two is that it must have a cost that can be measured reliably. Costs. If it does not have a cost that you can measure reliably, you cannot recognize it in the books. And you can guess what cost is. Cost is the amount that is paid for the asset, abi? Or maybe other consideration that can substitute the amount. Meaning that it's possible that they give you an asset for free. Then you need to get what's the fair value of this item. If I were to buy it, how much would I have paid? So when we say costs, it might not necessarily mean that you paid for it. What is important is that can you get the costs reliably from a relevant third party? So cost is the amount that is paid to acquire an asset or the fair value of other considerations that you can pay to acquire it. Okay, that's the cost. And these are the two recognition criteria for an asset: future economic benefits and costs. How do you then recognize it in the books? When it has met the recognition criteria, then put it in your books. Abi? What's the double entry? What's the double entry for recognition of PP? Who can tell me? Debit what? No. PP. You have to be very specific. Credit what? This, if you have paid for it. What if you bought it on credit? We call it other payables because payables is huge. There could be trade payables, other payables like that. What if they gave you for free? What if you are given for free? It's possible. Abi? We are accountants. We need to know how to account for everything, whatever the situation. Don't finish it. Don't finish it. It's not discount. What if you are giving for free? Equity. Yeah, you try. It makes sense. It makes serious sense, but it's not share capital. It makes sense that they gave you an asset for free, then it's part of your capital. Yeah, intelligent, but it's not. Income. Who said so? That's correct. Go back to the conceptual framework. Income is an increase in assets. Yeah. You can get it from there. You can get the answer from there. So when you are not sure of everything, then you can, I will change your position. So income is an increase in asset. So when you're giving for free, is an income. Is an income. So these are the double entry that can occur for PP. Any questions? Any questions? Okay. Let's go to the third one. What do you say? Please ask.
Normal purchase.
Yeah.
So it's either bank or cash. That's what they are.
Yes.
So if you are given for free, it will be other income.
Yes.
This category of other pay.
If you are buying it on credit, if you are buying it on credit, okay. Remember the chapter 6 of the conceptual framework that talks about measurements. Under measurement, we mentioned measurement basis, and we said there are two measurement bases. There is the historical cost, and there is current value. And those are the measurement bases we use in reporting. Bringing forward that knowledge, That's what I want to talk about here. How do we measure PPE? When you buy an item of PPE, how do you measure it? So anytime going forward I mention measurements, be sure that I will mention two levels of measurement. Two levels. The first level of measurement I will mention is the initial measurement. This is the first level of measurement I will mention. And the second level of measurement I will mention is the what? Subsequent measurement. So I will mention initial measurements and what? Subsequent measurement. Why do we have two levels of measurements? It's because number one, we need to get how much at the transaction date. This is the transaction date, which is the date you actually purchase the assets or you acquire the assets. So that measurement at that date, we call it what? Initial measurement. That measurement at that date is called what? Initial measurement. Then, subsequent measurement is the measurement at the end of each year. At the end of each year. But, I mean, this is a financial reporting class. We actually call it at the end of each reporting date. Okay? At the end of each what? When I ask you questions, there are some things I have taught you that I believe you should be bringing forward that knowledge. There are some terminologies you need to be, so that you are in financial reporting class. We need to be speaking in reporting. So going forward, I will not be talking about the end of each year. Anytime I want to say at the end of the year, you hear me saying reporting dates. When I say reporting date, I mean at the end of the year. Okay? So the measurements at the beginning of the year, not necessarily at the beginning of the year, the measurement at the transaction date, we call it what? Initial measurement. While the one at each reporting date, we call that one what? So at every point I'm discussing measurement, I always talk about those two. If I don't, remind me that what about the initial measurement? Because that is how it is in reporting. So now, let me start with the initial measurement. This one. So how do you measure PPE? The date you bought it, which is the transaction date. IAS 16 says that you should measure it at cost. It says you should measure it at what? Cost. Is it 3 diets ago or 2 diets ago? I can't remember. For 7 marks, I can say that list the component of cost according to IAS 16. List the component of the cost of PPE according to IAS 16. So when we say costs, you already know that cost is the amount you paid for an asset or the fair value of other consideration you might have given for that asset. But what does IAS 16 talks about? The component of costs of an asset. He said the cost of an asset comprises the purchase price, which is the price you purchased it, plus import duties, plus non-refundable purchase prices or purchase taxes, less trade discount or rebates. Less trade discounts or rebates. So component of costs. The first component is the purchase price, which is of course the price you bought it. So plus import duties. That's if you are importing it, you pay custom duties. That's where this is applicable. Plus non-refundable purchase taxes, that's VAT. Okay, because this is an international standard, they just call it purchase tax. In Nigeria, we call it what? VAT. It's part of the cost of that asset. Okay, but it has to be the non-refundable one. Because for those of you that work as an accountant, you should know that there are some VATs that you can reclaim from FIRS as inputs. Okay? Those ones that you can reclaim, you cannot add that as part of the cost of that item. So if you bought an item and that same item, you are still going to resell it and charge VAT. You know, when you want to remit the VAT to FIRS, it will be output minus input. You pay the net. Okay? But this one, we are talking about VAT that you will never reclaim. They are non-refundable purchase taxes. Then that is also added. Then if there is any trade discount or rebates, that will be deducted. Less trade discount or what? Rebates. That should be deducted. And trade discount is particularly important because there are two types of discount. We could have cash discounts. We could have trade discount. Is there anybody here that can tell us the difference between cash discount and trade discount? Belumi, you want to try? Is what? Okay, your idea is correct. So trade discount is when you buy bulk, they give you trade discounts. Okay, but it might not be only that. Trade discount could be if you're a first-time customer. You are working to the supplier the very first time and he decides to reduce the price for you. He says, okay, because you are a first-time customer. Or probably maybe the guy is doing buy one, get one free. That's a trade discount. Those are trade discounts, okay? All these promotions and all of that, they are trade discounts. And for cash discounts, for this one, it has condition attached to it. For you to get cash discount, you must have paid early. The only condition attached to that discount is that you must what? Pay early. That's why in some instances they call it early settlement discount. They call it early settlement what? Discount. That if you pay early, fine. But if you don't, you won't. So it's a conditional. So the discount that we are talking about here is trade discount. Why I'm emphasizing this is this. ICANN will always give you the two. They will give you early settlement discounts. They will give you trade discounts. They will now look at you and see which one are you going to what? Choose. So if they tell us that, where is it? Let me put it here. If you bought an asset for 10,000 and we're going to give you 5%, 5% reduction if you pay early, and we're going to give you 1% reduction as a first-time customer. What's the cost of the assets? The cost of the assets is 10,000 minus 1% of 10,000, which is how much? 100, Abi? And that is 10,100. 9,900. You see, the good thing about this discount is that on your invoice, on the supplier's invoice, is 9,900 that will be on it. So even the way to identify trade discount from the supplier, they will have removed it. That's why in double entry, you will not find any double entry for trade discount because the supplier has already removed it right from the get-go. But you will break it down that this is my cost, though, but I'm giving you this discount, and that's that. So it's 9,900 that will be the cost of this asset. But for knowledge purposes, that has nothing to do with this one. This 5% reduction, okay? If let's say you paid early and you now get it, let's say it's 5% of 10,000, which is 500 naira. Abi, how will you record it in your books? You get it, you paid early, they gave you. How will you record that in your books? Discount. That's correct. Absolutely correct. So how do you record it in your books? The discount received will go in as a what? That's perfectly correct. That's perfectly correct. So you credit other income. Abi, what do you debit? Mm-hmm. So are you saying you are going to debit bank? You tried. I mean, you're very reasonable. So if is this one, I'm just teaching you because this is a reporting class. It doesn't really affect this. I'm still going to go on with this. So this 5%, ordinarily, when you bought these assets, 10,000, for you to even be talking about this one, it means you bought it on credit. That means, you see, at the transaction date, have you paid? Now, so does that mean you won't enter it in your books until you pay? You still enter it in your books at the date you bought it now. That is initial measurement. The date you bought it, you will enter it in your books now. Abi, did you pay? You haven't paid now. That's why the guy said, okay, if you pay early, we'll give you discount. Why are you saying we have paid? Have you paid at the transaction date? Because the reason why 5% reduction is coming in is that if you pay early, you will get it. So for you to even be talking about this, that means initially you bought it on credit. So you credit other payables. With also how much? With 10. This is how you'll have recorded it. So the guy now said, if you pay early, okay, I will reduce your price for you by 5%. So let's say you now met those payment conditions. So that means when you want to pay, how much are you going to be paying? 9.5, Abi? So you pay 9.5. So we are talking about the discount that you have gotten now, which is 500. So you say you credit discount what? Received as an income. What will you debit? Other payables. You debit other payables. Why other payables? Because when you were settling this 10,000, you only paid 9.5. So that means you credited bank and you debit what? With how much? That means these other payables will have a balance of how much? Which is the discount. So by the time you credit that discount to P&L, You debit the other payables to close it out. That's just another day discussion, but at least if you have gotten that, keep it. It will be useful later. Now let's come back to what we are talking about. So we are saying the component of cost is the purchase price, import duties, VAT, then your trade discount. Trade discount, very important. Now, number two, another component is directly attributable costs of bringing the asset of bringing the item to its location and condition. So another component of the costs of PPE is what we call directly attributable costs. Directly attributable costs. That's the second component. And this directly attributable costs is simply the costs of bringing the item to its location and condition. So that location is for you to bring it to where you want to use it, and condition that is now going to be capable of operating in a manner that you intend it to operate. So any costs you incur to bring the asset to its location and condition for it to be capable of operating in the manner that you intended, that you can start working perfectly. All those costs you incur within that period, we call it what? Directly attributable costs. That means that any cost you now incur after the asset is already in its location and condition, are those directly attributable costs? No. Those will not be part of it anymore. Directly attributable costs as a bound is after you have purchased it, the cost you then incur to bring it to its location, to bring it to its condition, for it to operate in a manner that you intend, or for it to be ready for use. That is directly attributable cost. Any cost after it is ready for use, any cost after it is operating, is not directly attributable what? Cost. Yes, it is part of it. So, I mean, let's list them. She has mentioned one. Let me call it assembly costs, assembly and installation costs. So these are examples of directly attributable costs. So let's say you need to assemble those products together and you need to do some installation. Okay, let me separate it. Let me call this initial delivery and assembly. Okay, then let me call installation costs separately. Okay, let's say there are handling costs. What can handling cost mean? Cost of packaging the item, or probably when you were on the way, you have to give, maybe Agbero stopped you, you have to give them money, or police people stop you, you have to give them money. Any cost you have incurred to ensure it is properly handled to its location, that can come as handling costs. What again? You can have site preparation costs. And what is site preparation cost? As the name implies, if it's a land that you are buying, site preparation cost is simple as you want to clear the site or you want to do a building. And if it's a big structure you are buying or like a generator, site preparation can be probably you want to do like a pavement for it or a shelter for it or shelter for it. That can be site preparation cost. So that's site preparation costs.